Hi, I'm Rob Rowan with CFA Society New York. The following podcast was recorded on March 12th, before the substantial central bank movements of the last week. We decided to put this podcast out today, despite the lack of commentary on the recent movements, because the long-term trends here remain important. Here's the podcast. This is Compound Insights, a podcast by CFA Society New York. I'm your host, Rob Rowan. Today we're talking about the developed world's global monetary policies. For this conversation, we welcome back Paul Sheard to the podcast. He is a senior fellow at Harvard Kennedy School. He was vice chairman of S&P Global and held chief economist positions at Nomura, Lehman Brothers, and was head of Japan equity investments at Baring. He has been a lecturer at Australian National University, Osaka University, and Stanford. And he has served on councils for the World Economic Forum, is a member of the Bretton Woods Committee, and was appointed to positions in the Japanese government by not one, but two prime ministers. I'll leave it there, but would encourage you to read Paul's bio on our website because I left out a lot of details of his very impressive career. So, Paul, thanks for coming back.
Pleasure, Rob.
Because you spent some time of your career in Japan, why don't we start with Bank of Japan, which is facing some difficult issues. There's the impact of the VAT increase on the fourth quarter growth, the difficulty in raising spending, and now the need to keep the yen in healthy range, and there are some fears around COVID-19. So how do you read all that?
Well, the Bank of Japan probably is an appropriate place to start, Rob, because the Bank of Japan has really been the trailblazer and the pioneer of what we call unconventional monetary policy, which
Right.
increasingly people are now calling the new monetary policy tools.
Right.
And in fact, I was in Japan at the time when the Bank of Japan launched quantitative easing, didn't call it that, in March 2001. That was a 5-year experiment. But the Bank of Japan was also a pioneer of credit easing, forward guidance, even some macroprudential measures that they took as well. So the latest round of that under Governor Kuroda, who started his tenure in March 2013, and very unusually for a Bank of Japan governor is having a second term.
Yes. Yeah.
He was really the monetary policy guru for Abenomics. He launched into what was called quantitative and qualitative easing. So that's the QE, and it's also the kind of the credit easing part of things, buying equities and other risk assets to try to reduce risk premium and help support a broader range of asset markets. He pioneered that policy, didn't quite pioneer negative interest rate policy. The Bank of Japan went negative minus 10 basis points on the overnight rate in January 2016, so a little bit behind some of the European central banks.
Right.
But the Bank of Japan under Governor Kuroda has pioneered a new, at least in the modern era, monetary policy framework, which is yield curve control. And basically what that means is that the Bank of Japan is now targeting or anchoring 2 points on the yield curve,
Right.
not just the overnight rate, the conventional thing to do, but also the 10-year JGB rate at around 0%. And other central banks are eyeing this policy framework. They haven't got there yet, but they're certainly looking at it as something that potentially, if they need to do even more unconventional monetary policy in the future, they might go the direction of the Bank of Japan there as well.
Right. And I wonder if there is a sense from the other bankers if we're going to see how this goes with Japan and then decide.
I think there's an element of that. I've used the term sequential peer learning to
Right.
describe the process by which all of the central banks are looking at each other. They obviously, they're colleagues in the international monetary system. They meet together at the BIS and other fora, IMF, etc. They all know what each other is doing. They're all in close contact. They're all looking at each other's monetary policy frameworks and actions and how effective or not they are. And so there's been this process by which one central bank tries something and eventually it diffuses to the others. I would not be surprised. In fact, I would be fairly confident that at some point in the future, given the world we're living in now, with very low natural rate of interest, or R star, as it's called,
Right.
in the central banking jargon,
Mm.
I would fully expect that some other central banks in future will explicitly, overtly engage in yield curve control. Maybe initially not out to the 10-year point. The Fed, for example, particularly one of the governors, Leo Brainard, has talked publicly about maybe the Fed could do that out to 2 years,
Okay.
but maybe not 10 years. So
Right.
that idea is really out there in circulation. But we'll have to wait. Obviously, that they need the reason to do it
Right.
before they'll move in that direction.
Right. Well, we're recording this podcast in nearly mid-March here, and the 2 days ago, the 10-year hit 0.88. So maybe we're getting there. Who knows? The you know the well, let's shift now a little bit to the Bank of England, a bank that I know you admire quite a bit for its structure, communication, et cetera, and I think that is notable. But it also has some problems that are pretty significant. It has obviously the much talked about Brexit. Growth has been slowing in its region for some time, and it also may have some COVID-19 fears that impact growth. So, what are you expecting for the Bank of England?
Well, first of all, on the Bank of England, I think it is a premier central bank, and I think the Bank of England's framework is very good. What they tend to do is be very, very clear with their framework. They've actually got three committees. They've got the Monetary Policy Committee, they've got the Financial Policy Committee, and they've got a Prudential Regulatory Committee. And these three committees all take different parts of the terrain. And they've really, I think, internalized in their framework very well one of the major lessons from the financial crisis and the Great Recession, which is that central banks have to be acutely aware of the transmission of their monetary policy through the financial system, if you like, the credit easing channel.
Right.
And also, there needs to be a macro prudential framework. They need to worry about how are the risks looking, and how's the behavior of the whole banking system and the financial system. And so the Bank of England has these three committees. The governor chairs each of them, but each of them has a slightly different mandate.
Right.
I'm a little bit more positive about the UK economy, although it's being hit with, it's got the Brexit shock, which is still hasn't really hit the economy in full force,
Right.
because while Brexit has happened on paper, it hasn't happened in reality yet.
Right.
That will
Right.
come the end of this year, or the 1st of January 2021.
Mhm.
So that shock is out there, although it is having an effect on the economy in terms of dampening sentiment and particularly business investment because of the uncertainty tax, if you like. Now you've got this COVID-19, but as we speak, of course, yesterday, the Bank of England did move across all of those three margins of policy that's under the purview of the Bank of England, cutting interest rates down from 75 basis points to 25 basis points,
Right.
but also reducing the counter-cyclical capital buffer
Right.
on the banking system to shore up the ability of the banking system to support SMEs. They introduced another sort of funding for lending scheme, and also doing some tweaking on the prudential side as well. So um, look, the UK economy, I think, comes into this phase actually in much better shape than the Eurozone, for example. If you look at unemployment rates,
Right.
you look at where GDP is in absolute terms relative to pre-crisis, but also the UK, let's not forget, has got, if you like, the full panoply set of monetary policy and macroeconomic policy tools. It's
Right.
got
Right.
it's good coordination between monetary and fiscal policy. They have their own currency. They have their own exchange rate, which is flexible. And they have a pretty good track record with policy. Where I look at the euro area, on the other hand, you see a much more convoluted system. And frankly speaking, a macroeconomic policy framework which is only half built.
Right. And, the ECB may have to deal with some COVID-19 issues as well because of the rather large movements taken in Italy. They also have the commitment to keep rates negative, so lower for longer, which requires some things. And then they have to contend with some of the different opinions around those things. So could you broaden your lens a little
Mm.
bit on the ECB and what its next steps are?
Well, again, as we do this podcast just today, of course, probably as we're speaking, Madame Christine Lagarde, the ECB president, is winding up her press conference.
Right.
So they did some things today, kind of similar in a way to what the Bank of England did yesterday. So all of the central banks now, because of this shock, the COVID-19 shock, are having to react to that. But just to sort of zoom out a little bit and pick up on my previous comments a moment ago, the problem with the ECB is the ECB is the central bank for a 19-member state monetary union, which
Right.
is not a fiscal union,
Right.
which is not even a complete banking union. So
Right.
there's an agenda to build a banking union, to complete that banking union, but it's still work in progress. They talk about a capital markets union.
Right.
But most importantly, it is not a fiscal union.
Mm-hmm.
And in fact, because it's not a fiscal union, there are constraints in place through the various treaties, particularly the Maastricht Treaty, but also the more recent Fiscal Compact, which essentially may put individual governments with their fiscal policy in a fiscal straitjacket. So you don't have the capacity or the bias to use fiscal policy quickly as a counter-cyclical tool, let alone coordinate it with monetary policy. It's the opposite of coordination. The ECB is very independent of the other of the fiscal authorities of the 19 countries. So the ECB is, in some sense, in that case, sort of needs to overcompensate with monetary policy because the fiscal policy support is not there. But there's a lot of political resistance to that. And there's always the criticism that the ECB is overstepping its mark and straying into quasi-fiscal territory. But in some sense, it has to do that because the fiscal authorities, on that side of the coin, there's a little bit of a vacuum.
Right. That's why I asked that question about the opinions that go around about this. Well, I wonder if there is, in your opinion, there is a little bit greater risk about policies going forward just because there's a new sheriff in town.
Well, I think the appointment of Madame Lagarde, who took over in, I guess, November it was, for an 8-year term. The president of the ECB has a very long term,
Yes,
8 years.
compared to most others, yeah.
And, I think it's interesting to reflect back on Mario Draghi, the previous governor or president who came in November 2011. Over the course of his 8-year term, there were tremendous changes in the ECB's policy. The famous OMT, outright monetary transactions, essentially a commitment by the ECB to do whatever it takes to hold the euro together. And then later on, negative interest rates in 2014, and then QE, quantitative easing, or asset purchases, which the ECB is continuing to ramp. Did a lot, stopped for a while, started again last September, and now is actually, with today's decision, doing even more. So I think my view is that the framework, as I said, in the euro area is incomplete and inadequate to deliver proper macroeconomic policy support to the economy. And every time you get a shock, and we're getting another one now, the economy is pushed down, and it puts this extra strains on the ECB. So I think you're going to see an evolution, Rob, over the next few years under Christine Lagarde, who is not a technocrat,
right,
in the traditional central banking genre. That is, she doesn't have a PhD in economics,
right,
like Mario Draghi did, or Ben Bernanke, or Janet Yellen, or Mervyn King. But she's much more of a sort of a financial diplomat and somebody who can really finesse issues with the political authorities. And I think that the ECB, per force, is going to have to go in this direction unless we get the action from the European Council, that is the member states of the EU, in particular, and the European Commission, to really move much faster on building the banking union, completing it, capital markets union, but most importantly, fiscal union, so that you've got a fiscal capacity which is able to step up and relieve some of the pressure on the ECB. But I don't expect that to come quickly. So what I'm expecting, and I actually wrote an op-ed on this the other day, is I've been pointing out for some time that the ECB actually has a much broader mandate under the treaties,
yes,
to do stuff that in the past they've basically been frowned upon from doing.
right.
What do I mean by that? Many people say the ECB has a single mandate of price stability, and that makes the ECB different and more constrained. If you actually read the treaty, it doesn't say that. It says they have a primary mandate of price stability. But then the next sentence says, without prejudice to price stability, the ECB must contribute to various goals of the European Union, which include full employment.
Okay.
And other things such as a sustainable environment and good stuff like that, social cohesion. But full employment is the key one, I think. So what that really says is that the ECB should not be taking measures to pursue full employment that come at the sacrifice of price stability. But they don't have a get out of jail free card when it comes to worrying about unemployment. So long story short, Rob, I think what's going to happen is, particularly with this review that the ECB launched under Madame Lagarde, which will run through until the end of this year, they've signaled, I think that you'll see an evolution of the way in which the ECB thinks about its mandate, conceptualizes it, but more importantly, communicates to the world that it does have a broader mandate, more flexibility. And I think that will then probably over time be backed up by policy action that may stray a little bit in the fiscal area that in the past would have been out of the question, or at least heavily criticized, but which can be justified under the framework and the treaties that operate in the European Union.
Yeah, I've never really reflected on that. That is significantly different from the dual mandate of the U.S. Fed. The Maybe this is a good time to switch to the U.S. also, because things had been going along quite well until recently. So the U.S. now has some COVID-19 issues. Did lead to a loosening. Did, as I said earlier, did push the 10-year down to 88 bips. But the Fed also has this review of its monetary policy strategy, tools, and communication. That's going to roll off this summer. So, what do you think will come of all of those things?
So the Fed has launched that review in November 2018, and they did a lot of work last year, and particularly centering around what they called Fed Listens events. 14 of these. They went around the country and they sought input from local communities and different kind of constituencies that are influenced by monetary policy. What they've been struggling with, Rob, again, with apropos of many central banks, is the concern that interest rates are not going to get up to where they were before. In other words, central banks, the Fed and others, when they come into the next recession, which may be upon us now, who knows, will not have very much monetary policy ammunition.
Right.
So in the Fed's case, they got the federal funds rate up to 2.25% to 2.5%. But typically, the federal funds rate, in a normal situation prior to a recession in the post-war period, because it depends on the inflation rate, but it's typically they've had 500 basis points or more of interest rate ammunition. So the Fed said, we need to start thinking now, back in November 2018, about if we do move into a recession in the future, what sort of policy tools will we be able to mobilize? But the review, so they're thinking about, obviously, they're incorporating quantitative easing and forward guidance and these tools into their framework as normal tools. But the discussion really is more about so-called make-up strategies. What does that mean? It says that if you've been running, if inflation has been running well below target, or below target for a very sustained period, which is the case in the US, you're consistently missing your 2% inflation target. And that can lead to the danger that the public's inflation expectations start to adapt to lower inflation.
Which they probably have.
Which they have. And inflation expectations drive inflation outcomes. So you could get into a sort of a Japanese situation where inflation falls, inflation expectations fall, and that becomes embedded, and you get in this structural low inflation. So what they've been talking about is different tweaks on the framework, which would involve perhaps compensating for, making up for periods of underinflation. For example, targeting average inflation rates. In other words, that would essentially say, if we've had a number of years of 1.5% inflation for a period, we're going to try to get 2.5% inflation to kind of, so that over time, net inflation is around 2%. And the idea is that if they can do that, explain it to the public, that's going to be a challenge, and convince the public that they actually can achieve what they want to achieve.
Which will also be a challenge.
That will sort of ratchet up the public's inflation expectations and make monetary policy a little bit more potent. So I think that's the key idea they're experimenting with. We'll see the summer a little bit beyond what they actually come out with. I think at the end of the day, it's not going to be game changing. I think this is a fairly narrow discussion within the confines of monetary policy. I would have liked to have seen the Fed perhaps reaching out to the administration, to the Congress, and having a broader discussion about, let's face it, in a future downturn with limited monetary policy ammunition, fiscal policy is going to have to play a big role as well. And, should we be thinking about frameworks or mechanisms that allow more coordination and joint action to take place it kind of happens in emergencies, but wouldn't it be nicer to have some kind of framework where this was expected and worked rather smoothly?
Yeah, I'd like to just accent one of the things you just said there. The Fed does have an rather awesome task in front of it to do the communication portion of this. Even now, when the investing public is quite focused on one issue only, and that's kind of how it happens most of the time. It's hard to focus people on emergency procedures when there's no emergency. Anyway, much less this particular public, which is going from hot dot to hot dot right now. And then there's been the difficulty of the legislature and the presidency, which has presented these types of problems that I think most people don't quite think about. So I just wanted to inflate.
And we're in an election year, and the discussions around these issues in the US are infused with partisan rhetoric and partisan emotions. But we've talked about the Bank of England, we talked about the ECB, Bank of Japan, we got on to the Federal Reserve. When you look across those different central banks, I think the US in some ways is a little bit closer to the ECB in the sense that they have a very challenged framework. As I've been arguing for some time, I do think we're in a world where you need closer and effective monetary and fiscal coordination. It's much easier to do that in a Westminster parliamentary style system. Australia, New Zealand, Japan, the UK. In the euro area, you only have one half, which is the monetary and not the fiscal. Now, you do have monetary and fiscal in the US, but you have this separation of powers, and monetary policy is very much the Fed's preserve, but the Fed is part of the administration, but independent within the administration, but answerable to Congress. And fiscal policy is kind of a joint responsibility of the Congress and the administration. And so you have a very complicated kind of setup there. And if you infuse, so a lot of coordination needs to take place between different entities with different kind of, you know, characteristics or personalities, institutionally speaking. And then you infuse a dose of partisanship into that. That just complicates things even more. So the US usually gets there with its coordination. We saw that in 2008, 2009, despite the difficulties of the framework, not so much because of it. But it is a lurking risk that, at some point in time, maybe the system will not work as quickly, as effectively as it has in the past. And the US is the most important economy in the world. The dollar is the most important currency, and the Federal Reserve is the most important central bank.
Well, that's all great. Thank you very much for your time there. To listeners to this podcast, I will post on the show notes the op-ed piece that Paul just mentioned on the ECB, and I've just strong-armed him into writing a little historical piece on the BOJ. So you'll look for that there too. Thank you for listening into Compound Insights by CFA Society New York. You can find our other episodes on the podcast app of your choice and our website, cfany.org.